Apple just authorized a record-shattering $110 billion stock buyback, the largest in U.S. corporate history. Wall Street cheered, analysts praised, and the market responded with enthusiasm. But beneath the headlines and the financial buzz lies a bigger question. Is Apple leveraging its financial strength to lead innovation and transformation? Or is it playing it safe by funneling money back to shareholders? This story isn't just about a financial maneuver. It's about the future of one of the world's most iconic companies. Let's break it down. A stock buyback, or share repurchase, occurs when a company buys back its own shares from the open market. This reduces the total number of shares available, which increases earnings per share, EPS, since profits are now divided among fewer shares. Investors often view this as a signal of strength, especially when the company believes its stock is undervalued. Apple has used buybacks extensively as part of its capital return strategy. Since 2013, the company has spent over $700 billion on buybacks, reducing its share count and delivering consistent returns to shareholders. But the real question is, what are the trade-offs involved in this decision? Is the financial benefit worth the opportunity cost? Apple's leadership maintains that buybacks are a disciplined, strategic use of capital. The company generates enormous free cash flow, nearly $100 billion annually. And with limited acquisition activity and controlled capital expenditures, much of that excess capital has been returned to shareholders. Executives argue that buybacks enhance shareholder value, maintain share price stability, and demonstrate long-term confidence. They also highlight that Apple's capital return program includes dividends, which were increased by 4% alongside the new buyback authorization. But the size and frequency of these buybacks raise eyebrows, especially when innovation cycles are slowing and disruptive technologies are emerging rapidly. Wall Street loves predictability, and Apple delivers. The buyback announcement sent shares surging, adding over $160 billion in market cap in a single day. Analysts praise the move, citing strong capital discipline and commitment to shareholders. But outside of Wall Street, the picture is more complex. Critics ask, could this same $110 billion have powered groundbreaking advances in artificial intelligence? Could it have strengthened Apple's global labor practices or helped close the digital divide in underserved regions? Financial engineering delivers short-term results, but what about long-term resilience? What if the next revolutionary product or service never arrives because the funds went to support EPS instead of invention? Academic voices like William Lazanick and financial commentators from both sides of the aisle argue that Apple's buybacks represent a shift away from stakeholder capitalism. They point out that nearly all of Apple's profits in the last decade, over 90%, have gone toward buybacks and dividends. That's hundreds of billions that might have fueled next-generation innovation, built out green infrastructure, or improved supply chain labor conditions. Some call this a missed opportunity. Others see it as a broader trend in corporate America, prioritizing stock price and executive compensation over broader societal impact. For a company that's helped shape the modern digital age, this is a debate worth having. There's no denying Apple continues to innovate. Its M-series silicon chips have changed the game for computing performance. Its privacy standards set benchmarks across the tech industry, and its investments in healthcare and wearables suggest long-term ambition. But critics argue these efforts pale in comparison to the scale of its buybacks. Google and Microsoft are investing aggressively in AI. Amazon is pushing logistics and cloud infrastructure. Is Apple's innovation pipeline still bold enough to justify its buyback-first approach? And more importantly, could a greater emphasis on long-term research projects result in another category-defining product, one that transforms the market as the iPhone once did? What would Apple look like if it reinvested 25% more into fundamental speculative research that might not pay off today, but could shape the world of tomorrow? Buybacks aren't inherently bad. They can be a signal of maturity and fiscal strength. But when they dwarf investments in people, research, and future-facing ventures, they raise serious concerns. Economists argue that reinvestment drives long-term competitiveness. It sparks new products, creates jobs, and builds resilience. Financial optimization, while rewarding in the short term, may slow down the engine of innovation. Apple may be maximizing EPS today, but is it maximizing potential for tomorrow? By reallocating even 10% of its buyback budget to moonshot projects, like advanced AI, biotech integration, or global education platforms, Apple could secure an even more dominant position in the next decade. Apple faces mounting pressure from shareholders, employees, and the public. Consumers expect sustainability and transparency. Workers want fair wages and upward mobility. Governments demand local investment. Apple has made progress: carbon neutral goals, supplier responsibility programs, diversity pledges. But with its resources, many believe it could do more. A $110 billion buyback might impress markets, but how would that same amount look invested in clean energy, rural broadband, or educational equity? What message does it send when innovation takes a back seat to financial maneuvering? And how would the world respond if Apple chose to lead a movement where trillion-dollar companies put 10% of profits toward planetary-scale challenges? History tells us that companies who over-rely on buybacks often underperform in the long run. IBM, once a tech titan, spent billions buying back stock but missed out on cloud and mobile revolutions. Meanwhile, firms like Amazon chose to reinvest, sometimes at the cost of short-term profits, and emerged as industry leaders. Apple has already built one of the most valuable companies on Earth. The question is whether it wants to preserve that wealth or keep expanding it through bold, visionary moves. Apple's $110 billion buyback is many things: a signal of financial dominance, a commitment to shareholders, and a bold bet on itself. But it also forces a conversation about values, leadership, and legacy. And let's not forget another key piece of the puzzle: Apple's global influence. As one of the most recognizable brands on the planet, Apple's actions often set industry benchmarks. When Apple chooses to spend over $100 billion on a stock buyback, it sends a message, not just to investors, but to competitors, governments, and the public. Is the company signaling that it has no better use for its cash? Or is it reinforcing a belief that rewarding shareholders is the ultimate measure of corporate success? There's also the question of transparency. Critics argue that while buybacks are easy to explain on a balance sheet, they often lack the visibility and accountability of other investments. Unlike a new product launch or a green initiative, a buyback is quiet. It happens in the background. And for a company like Apple that prides itself on innovation and vision, some ask if this silence speaks louder than words. Should the world's richest tech company do more to build the future we all share? Or is maximizing shareholder return the most responsible path? This decision could shape how companies around the world view capital allocation. Apple stands at a strategic inflection point. What it chooses to prioritize next may shape not just the next quarter, but the next quarter century for itself and for much of business industry as well. So, what do you think? Is Apple's $110 billion buyback a brilliant move, or a missed opportunity to lead more boldly into the future? Drop your thoughts in the comments. Like this video if it made you think, and subscribe for more business deep dives. Thanks for watching. We'll see you in the next one.